Hey, it's Clay at claytrader.com, and in this video, I want to show you a very important skill. In fact, the one skill that would literally make the difference and separate two people from either making 50% or losing 50% on the exact same stock. And it's one of those skills, it's one of those strategies that when you're new and just getting started, or who knows, maybe you have a lot of experience and you're wondering why you're struggling as a trader, it may very well be the component that you're just not grasping and or not even paying attention to or aware of. And in my opinion, it's one of the more important, maybe even one of the most important skills that you have to have. And it's a little backwards, it's a little bizarre because at first, it doesn't seem to make any sense, but if I do my job right here in explaining, I'm going to show you exactly how it works. And I should also note that this is kind of almost a part two in a sense. If you're curious and if you want the best experience, quote unquote, then I'd say go watch this video, not necessarily first, but maybe immediately after I'm done with this video, because it's, that they feed off each other and they're showing you examples of the exact same thing. And on that note, I'm going to show you real life examples. I'm going to use a real life situation that played out. That way we can avoid me just sitting here talking to you in theory about things. I can show you exactly how this principle, how this skill plays out in the real world of trading. So the skill here is based off of what I call the PIT principle. And the PIT principle states the following: that there is profit in learning and understanding to identify when and what to avoid, or in other words, there is profit in avoidance. What do I mean? How does this actually make you money? Well, let's say that you have a $500 account and you go out there and there's a pit being a situation that could be avoided, right? If you take notice of it, if you understand it, then you could avoid falling into the pit. But let's say for whatever reason, you don't see the pit, or you aren't aware of the pit. You don't have the knowledge to see or realize that it's sitting right there in front of you, and you walk into the pit and that pit costs you, $300. Well, by the time you climb out of the pit, what are you going to have? You're going to have $200 left. And not to insult your intelligence, but that's actually less than 500, right? Because you've lost money by falling into a pit. Whereas if you do understand, if you have learned when you should be avoiding things, what to avoid, then you're going to what? What does that mean as far as this analogy is concerned? That means you have noticed the pit. So if you see the pit, because I'm assuming you're a rational person, you're going to just, avoid the pit. You're going to walk around it. So when you get over here, what does your account look like? Well, it's not at $200. You are still at $500. So did you technically make money? No, you didn't actually make money in the sense of you grew your account, but you avoided losing money. And as the classic saying goes, a penny saved is a penny earned. So in that sense, you actually made yourself $300. Because if you look at these two people, one person all of a sudden has $200. The other person still has $500. That's a big, big difference. And again, the whole idea here is it could have been totally avoided. And that's what the majority of trading is just avoiding things, not over trading, not forcing a trade. Or in other words, that's why you have to learn when and what to avoid, because many times you should not be in the trade, or you should not be thinking about taking a trade at a certain time. Now, like I mentioned at the beginning, I don't want to just talk in theory this whole time. I want to get and use a real life example so you can see exactly how the PIT principle plays out in real life. So what we're looking at here and what I'm going to do is I'm going to show you an alert that I made to members of my private community. And part of that community is I just send out weekly scans from my personal scans. So for this one, let's go to the week of 420 here. And the key one we're going to look at here is sticker symbol TRNX, and you can see called it a panic play, and the commentary here was uh-oh. So does that make you seem what? Well, there's a pit, right? There's a pit right there. Things are not looking good. Or in other words, like I said, looking like a pullback is coming. So if a pullback, meaning the price is coming down, is coming, do you think you should just buy right now? No, that would be a pit that should be avoided. Or in other words, be patient. It looks like a pullback's coming. Please don't throw yourself into a pit right now. So then I, just made a comment about creating enough panic. And then I mentioned right there, the low 20s. And then at that point, the RVR, meaning the risk versus reward, becomes much more logical. So that was a big question. You know what? Is a pullback coming? Is there going to be enough panic that actually brings it down to the low 20s via that green line. But that is the pit. Now, of course, I don't say, hey, there's a pit there, but right, you're a smart individual. You can see is not exactly a situation when you combine with pullback where, hey, I should probably buy right now, not to mention when it specifically mentions the low 20s, which is down here. So that is a pit that I alerted members to and that people would have been aware of. So let's see how this played out and then in the real world. So here's what the chart looked like at the same time of the alert, which I just showed you. And I want to kind of break this down into the two groups of people. So same exact stock, and we're going to have two groups of traders. The one group of traders is those people that just don't notice the pit. Why don't they may not notice it? Just because, we're all human. Sometimes we just mean something, which is why I believe there's value in a community in and of itself, because when you surround yourself with other quality people, sometimes, just like I said, you just miss a pit, but they might alert you to a pit like I did here. I'm just alerting other members to a pit. Or maybe this other group of people just didn't see the pit because, well, they don't even know what they're looking at. They're brand new. When you're brand new, just getting started, you don't know what you don't know. Maybe there's pits right there in front of you, but you just don't realize it's a pit. So, both of those could be possibilities. And then the other group of people is, well, the members that were alerted to the pit and that realize that, okay, let's just see what happens here. So the first candle right there, and one thing I should note is let's keep context in mind. Check out all this volume. Tons and tons of volume. The price has exploded upwards. So what do you think that is causing? That is causing a lot of excitement. That's totally normal. Huge volume, big price movement. Everybody's pumped up. Everybody's excited about it. It's very easy to fall into one of those pits. Have you been there before? I have, where there's so much excitement and then you just get in and then, what just happened, right? I have no shame in admitting I've been there before. But that's the context here is so much excitement, so much volume, prices exploding, and you can see that the day after the alert was made, the price opened right there. So what I want to do is let's just document this as the group of people that, maybe didn't see the pit. They got caught up in the excitement and they ended up buying right here at where it opened up 39 cents. Now, to make the numbers even worse, I could say, and they bought all the way up there, but we'll just assume that they bought right here at 39 cents. So have things documented. One group, again, just got 39, and then their group, I'm going to go with 23. Now, I said the low 20s, and I think 23 cents is fair, right? Maybe some people would argue, actually, no, Clay, that's the mid 20s. Well, whatever. We're going to go with 23 cents, and let's see what happens. So there was that first day. The next day, things pulled back quite a bit more. So again, the people that didn't realize the pit, now they're having to sit through a pullback. Exactly what I talked about, exactly what I warned. The next day right there, came down a little bit more. And then right there, check it out. Came down there, there's the low 20s. Members who noticed the pit, who were alerted to the pit and avoided the pit, again, being caught up in the excitement and buying somewhere up around here. Hey, look at that. It actually has pulled back to give them an entry point. And then the next day, you can see it started off, gave them another opportunity. So actually 2 days in a row to potentially get in there within the low 20s before spiking all the way up there to that level at 36 cents, which was a gain of 56%. So 56%. And the cruel part about this move was it was kind of a pretty big tease. So again, the people that avoided the pits, literally. Now, let me do this. I don't want to assume that like people played it perfectly. So let's just say that people kind of screwed up half the trade, we'll say. Now, again, could have very well made 50% because it went up over 50. But even if they didn't and screwed up some of the trade, think about it. That's only 2 days. Within 2 days, you got that big of a spike. And how was this all created, though? It was created by not buying up here, right? By avoiding that pit. You got to know, you got to learn, you got to realize that there is money, there is profit in avoidance. By avoiding the pit, it allowed you to get an actual great entry point and then turn a quick scalp, a quick swing trade, a quick whatever you want to call it type of trade. But this all occurred in 2 days. And the cruel part, like I said, was it started to spike upwards. So you know that the people that got up here, all right, it's coming back, building up all sorts of hope. And then you can see just a cruel move right there. And then pulled back some more, then pulled back some more, and then got really cruel. And at the time of this video, went all the way down here, which from 39 to where it is right now, literally a decrease of 50%. And for all I know, this thing might keep on going down. Sure, it might go up, but I mean, the worst thing that could happen is for this thing to go back up, and then everybody makes money, and then talk about the construction of a bad, terrible habit. But think about it. Literally, the one thing that separated people making 50% versus losing 50% was just not buying up around here. And I get it. Well, of course not buying up, but that's the whole idea, is when you use the proper tools, such as technical charts, when you have the knowledge to recognize those situations that need to be avoided. And sometimes the best trade is no trade at all. And that is what happened here. No trade at all was by far the best trade. Like I said, this isn't me talking in hindsight. It was all documented well before things even played out. And that's why you need to have full knowledge. That's why you need to understand and realize the situations that should be and need to be avoided as a trader. Now, if you enjoyed this video, a couple quick requests from me. First off, the easy way, the very fast way to communicate to me, hey Clay, please keep making videos like this. I enjoyed it. Just hit that like button. Super fast, super efficient. Also, check out the channel as a whole, and hopefully you decide to hit that subscribe button. Leave a comment down below. I mean, have you ever been there? Have you ever gotten caught up in the excitement? I mean, I know I have, so, you're not alone at all. But yeah, comment down below, or if you have any sort of questions or suggestions for other videos, I would love to hear from you. And then also, I talked quite a bit, and I showed the community in that, my personal scans and where this, TRNX all came from. So if you're interested in that, you can just learn more about it at claytrader.com/team, and that'll give you more details on the community that I offer. So thank you, though, for hanging out. Thank you for watching. Hopefully you learned something. Hopefully maybe you had something rekindled in your mind. Remember, there is profit in avoidance. There can be a whole lot of money you can make, quote unquote, by simply realizing and understanding what to avoid in the first place. So please hit that like button, leave a comment down below, subscribe to the channel, and I hope that you consider joining the community. Take care. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.